Hey everyone, and welcome back to the channel.
We're already well into 2025, and with all the economic shifts, geopolitical tensions, and talk about inflation, one question keeps popping up. Is gold still a safe investment in 2025? For centuries, gold has been considered the ultimate safe haven, a reliable store of value when everything else goes haywire. But is that still true in our modern, rapidly changing world? Today, we're diving deep to answer that question, looking at what the experts are saying, the current market trends, and what you need to know to make informed decisions about your money. Stick around, because you won't want to miss this. Historically, gold has acted as a store of value. Unlike fiat currencies, gold can't be printed, making its supply finite and inherently valuable. An inflation hedge. When the purchasing power of money erodes due to inflation, gold often retains or even increases its value, protecting your wealth. A diversifier. Gold tends to move independently of other asset classes like stocks and bonds, offering portfolio diversification and reducing overall risk. Scarcity. Its limited supply and the effort required to extract it contribute to its perceived value. So, how has gold actually performed in 2025? Well, if you've been watching the markets, you know it's been an impressive year. Gold has already seen significant gains this year, touching new all-time highs above $3,400 and even surpassing $3,500 an ounce by April. Some reports show a year-to-date gain close to 30%. This isn't a fluke. There are several powerful forces driving this rally. Let's break down the key drivers for gold's strong performance in 2025. Central bank accumulation. Central banks globally, particularly in emerging markets, have been aggressive buyers of gold. This isn't just about diversification away from the US dollar, it's a strategic move for financial stability amidst global uncertainties. We're seeing record levels of central bank buying, a trend expected to continue. Explosive ETF inflows. After a period of destocking, we've seen a massive return of financial inflows into gold exchange-traded funds, ETFs. This indicates renewed institutional and retail interest in gold as an investment. Lingering inflation concerns. While inflation may have cooled slightly, it remains elevated in many economies. Gold continues to be a go-to asset for protecting purchasing power, and central banks are expected to pivot towards rate cuts, which further diminishes the opportunity cost of holding non-yielding assets like gold. Geopolitical safe haven demand. The world remains a turbulent place. From ongoing trade tensions and regional conflicts to broader global instability, uncertainty fuels demand for gold as a crisis hedge. When traditional markets feel shaky, investors flock to gold. De-dollarization trend. Some nations are actively seeking to reduce their reliance on the US dollar, and gold plays a crucial role in diversifying national reserves and building alternative monetary systems. So, what are the top financial institutions and analysts predicting for gold for the rest of 2025 and into 2026? The consensus among many major investment banks is largely bullish. JP Morgan Research, for instance, has upgraded their forecasts, expecting gold to average around $3,675 per ounce by the fourth quarter of 2025, potentially climbing towards $4,000 by mid-2026. Goldman Sachs echoes this sentiment, with similar targets. Even more conservative forecasts see gold stabilizing in a higher range, suggesting that the new floor for gold prices might be around $3,000 an ounce, effectively replacing the previous $2,000 mark. These predictions are based on the continuation of the factors we just discussed: persistent central bank demand, ongoing geopolitical uncertainties, and the potential for further monetary easing by central banks. Even if fewer rate cuts occur than initially expected, the overall policy trajectory still favors easing, which is generally beneficial for gold. So, beyond its recent performance, what are the specific advantages of including gold in your portfolio right now? Portfolio diversification. Gold's low correlation with traditional assets like stocks and bonds means it can act as a crucial buffer during market downturns, reducing overall portfolio risk. Inflation protection. As we've highlighted, gold's historical ability to maintain purchasing power makes it a strong hedge against inflation, a persistent concern in the current economic climate. Safe haven during volatility. In times of economic and geopolitical stress, gold provides a sense of security and a tangible alternative to potentially volatile paper assets. It's often referred to as the crisis hedge. Tangible asset. For many investors, the physical tangibility of gold offers psychological comfort and a sense of true ownership that digital or paper assets don't. Increasing retail and institutional interest. Both individual investors, including younger demographics, and large institutions are showing increasing interest in gold, further supporting its demand and price. While gold offers compelling advantages, it's crucial to acknowledge the other side of the coin. No investment is without its drawbacks. No passive income. Unlike dividend-paying stocks or interest-bearing bonds, gold does not generate passive income. Its returns come solely from price appreciation. Storage and insurance costs. For physical gold, if you invest in physical gold, bars or coins, you'll incur costs for secure storage and insurance, which can eat into your returns. Market volatility. While generally less volatile than stocks, gold prices can still fluctuate significantly due to geopolitical events, currency movements, and supply-demand shifts. Capital gains tax. Profits from selling gold are subject to capital gains tax, and reporting requirements can be complex depending on your jurisdiction and investment type. Opportunity cost. Investing heavily in gold means that capital isn't deployed in other assets that might offer higher growth potential during bull markets. Historically, over the very long term, e.g., 20-30 years, equities have often outperformed gold. So, if you're considering adding gold to your portfolio, what are the different ways you can do it? Before you jump into any investment, especially gold, it's crucial to align it with your overall financial goals and risk tolerance. Your financial goals. Are you looking for capital appreciation, wealth preservation, or an inflation hedge? Gold tends to shine brightest in wealth preservation and as a hedge. Risk tolerance. While gold is a safe haven, its price can still fluctuate. Understand how comfortable you are with these potential swings. Portfolio diversification. Experts generally recommend allocating a portion of your portfolio to gold, typically 5–10%, rather than making it a core holding. It's a valuable hedge, not a silver bullet for all your investment needs. Long-term versus short-term. Gold is often considered a long-term asset. While it's had a strong run recently, short-term speculation carries higher risks. Don't expect to get rich quick with gold. Gold isn't the only safe haven asset, though it's certainly the most classic. For a diversified approach, you might also consider U.S. Treasuries and TIPS, Treasury inflation-protected securities. Government bonds are considered very low risk, especially TIPS, which are designed to protect against inflation. High-yield savings accounts and money market funds. These offer safety and liquidity, though with lower returns compared to gold or other investments. High-quality corporate bonds. From very stable companies, these can offer a balance of income and relatively lower risk than stocks.